But let me quickly introduce myself. My name is Phil Goldfeder. I am the CEO of the American FinTech Council. The American FinTech Council is a standards-based trade association looking to create sort of sound regulatory practices for emerging industries in financial services. And we rely on our membership. We're really driven by our members and our partners and those companies that we collaborate with to ensure that we're ensuring consumer protection and appropriate regulatory structures, but at the same time, not stifling innovation. The response to the proposed topic we have today was overwhelming. Obviously, open banking and 1033 and whatever you're going to call it over the last year has been the #1 topic in fintech circles on the conference circle and within our trade association and many others. And I'm very, very excited today to have brought together, I would argue, the leading industry experts on the subject. And more importantly, really, I would say the smartest folks on the subject matter. And I think that, while many people like to think that, there's a proposed rule, there's the feedback and the comment period, and then obviously the final rule, many people seem to think that that is sometimes the end of it. But I think with this one, given the vast size of it, in addition to the politics that we know have now shifted a bit, I think open banking is still very much in flux. And so I think there's no better people that you want breaking down sort of the industry and sort of the reaction. And arguably, the most important question is, what does the future hold? And so with that, let me just first and foremost say thank you to Derek. DR Bank has been a longtime member. And then also to Matt Janiga and Matthew, I just want to say thank you. Trustly has been not just sort of very involved in this conversation, but you guys have been leading from the front and haven't been shy about sort of not just about what Trustly wants for Trustly, but most importantly about what's best in the best interest of consumers. And so thank you, Matt, for joining us here today and for being part of this conversation. And of course, I'm going to kick it over to Jeremy. Morrison Foerster has been a partner of AFC for almost a year now and have been a tremendous contributor. And we appreciate your partnership all the time, but most importantly, Jeremy, with your expertise as it relates to this subject. So with that, Jeremy, I'll kick it over to you and obviously to introduce Natalie and the panel.
Perfect. Thanks, Phil. And glad to see you all, Matt and Derek, thanks, and Natalie as always. I think we're just going to run through some quick intros on top of Phil's intros, and then we're going to jump right in. We've got a short period of time here and a lot to cover. So I think what we'll do is just say a quick hello. As Phil mentioned, I'm Jeremy Mandell. I am a partner in our in Morrison and Foerster's Washington, D.C. office. I co-chair our financial services practice. My practice is generally a consumer regulatory practice, and so the 1033 rule has been a part of my practice for quite some time now. And so I'm happy to be here with AFC and with this panel talking about what was resolved with the final rule and what, to Phil's earlier point, remains a subject of discussion. And this rule has come to us at a point of change here in DC and in the market more generally. And so I think that it is interesting to get the diverse perspectives that are on this panel and that are in the market more generally, specifically at this point when there is such significant change. So I think I will hand it over to my partner, Natalie Fleming Nolen, and then Matt and Derek. I'll give you opportunity to say hello as well.
Hello, everyone. As Jeremy said, I'm Natalie Fleming Nolen. I'm a litigation partner in the Washington, D.C. office. I've been working on kind of banking and payments issues for a very long time, for my entire career, and have been really focused on challenges recently to government regulations, and particularly in the banking and payment sphere. And so I am here to bring you a perspective about litigation and the challenge that's already been waged against this rule.
Derek, you wanna go next?
Yeah, here we go. Hey everybody, Derek Henderson here. I'm the Chief Compliance Officer at DR Bank. Our bank is currently under the threshold of $850 million in assets to be in this bucket, although we do expect to hit that over the next couple of years. So We have a little bit of time, according to the timeline here, to comply, but certainly we're already thinking about what this means for a bank of our size.
And Matt.
Thanks everybody for having me. My name's Matt Janiga. Fun fact, I used to work at MoFo with Jeremy and Natalie, and then my wife wanted to move back to her home in California, and I didn't want to sit for the bar, so now I work in-house. I'm at a company called Presley, and we are the leader in open banking and pay-by-bank solutions globally. So this year, we're very excited. We are, any day now, should be crossing $100 billion of payment volume processed through Trustly, through the payment services that we offer, and all of that is powered by open banking. So whether it's the European market, UK market, Canada, or the US, we are using open banking to go out and help consumers share their payment information with merchants, and then use that open banking data for various jobs. We also do some data access work. So if you've heard of Plaid or MX or Finicity, Visa's building a similar solution. We do some of that as well, but our core job, we're really obsessed with merchant payments and thinking about how do we use open banking data to make those payments easier, more efficient, and also cheaper. So merchants turn to us because we can generally lower their interchange costs by anywhere from 30 to 50%. And with that, that concludes the pitch my marketing team tells me I have to make. I'm excited to talk more about this rule and this thing, because I love to nerd out on this stuff.
Great, thanks, Matt. So just a quick roadmap here. We've done our intros. We're going to give just a thumbnail on background and history. As Matt alluded to, open banking has been around for a long time, predates Section 1033 of the Dodd-Frank Act, but we will talk about the Dodd-Frank Act, and we will talk about the decade or so between when Congress passed Section 1033 and when we got the final rule earlier this fall. We'll then go into a high-level overview of the final rule. We'll talk about some key terms. We'll talk about the key obligations. And I think we'll try here to keep the conversation a bit more organic. As you've heard from both Derek and Matt, they each have different perspectives and different still from that of a regulatory lawyer. And so, I think what will benefit this audience will be to hear from each of the varying perspectives on not only kind of what the rule says and what it requires, but also what questions remain. So we'll take some time going through that. We will then turn to hear a bit more from Natalie, both about the challenge that succeeded, that quickly followed the publication of the final rule, and kind of the general litigation climate as it relates to pretty much anything that happens in DC these days. And then we'll kind of just bat back and forth some remaining questions, remaining open issues, and pontificate somewhat on what is next. So invite all the panelists to jump in, when they have something to add, but we'll start off here with background and history. So as I previewed, open banking as a concept has been around for quite some time. It has been a part of the US ecosystem for quite some time as well. From a legislative and regulatory perspective, it was a concept that was baked into the Dodd-Frank Act, specifically Section 1033 of the Dodd-Frank Act. That was passed in 2010. We are now nearing the end of 2024. Over the intervening 14 years, the Bureau has been doing significant work on not only learning the market and proposing a rule, receiving feedback on that proposed rule, and ultimately finalizing over the fall, finalizing the Section 1033 rule. While the Bureau has been doing that work, the market has not stopped. As Matt previewed, open banking has become a pillar of the consumer financial services market, the digital banking market, and the payments market more generally. So there has been significant innovation in this space while the Bureau has been doing its hard work in drafting the 1033 rule. That has been developing both from a technological perspective and a legal contractual perspective on a parallel path. So, we're not, the US market was not waiting for the Bureau to speak on this point. The US market has invested, and players in the US market have invested heavily in open banking, notwithstanding the fact that there was not a formal regulatory framework until the Bureau published its rule earlier this fall. That innovation was in part through API. It was in part based on some legacy technology, including through screen scraping, and it was underpinned by a web of kind of bilateral agreements as among data aggregators, data providers, and data users. So that is the structure of the market that this rule has been layered on top of. As with any good rule, as many of you will be familiar, the definitions are key. The definitions are key both with respect to who is covered by the rule, what is covered by the rule, and what is the scope of the rule. I wanted to take just a minute here to highlight a few of the key definitions in the rule. And this will kind of identify the key stakeholders against which we will kind of highlight the key obligations. So data providers is the first key definitional term. A data provider under the rule is an account holding financial institution. So think a bank or a credit union, a credit card issuer, a digital wallet provider, and there's a fourth bucket that is any other entity that controls or possesses information concerning a covered consumer financial product or service. So these covered consumer financial products or services are Reg E governed accounts, Reg Z governed credit cards, and the facilitation of payments from either the Reg E account or the Reg Z credit card. I think also what's important is what is not a data provider. So the Bureau was specific as to what covered consumer financial products or services are in scope for this initial rule, and that is asset accounts, checking accounts and the like, credit cards, and digital wallets. It's not other kinds of consumer financial products or services, so student loans, personal loans, BNPL, other kinds of consumer financial products or services. And then, to Derek's earlier point, also what is not a data provider, which is new to the final rule from what was proposed by the Bureau earlier, is small depository institutions. So those depository institutions with $850 million or less in total assets. So there's a little what is a data provider and what is not a data provider. Pause to see if anyone else wants to comment on data providers. If not, we'll shift to cover data.
Jeremy, I think the only thing I'd call out is that there's going to be a lot of companies that are both data providers and third parties. And I think, the Bureau kind of missed the mark a little bit here because there's an interplay where they map out a world of data providers and third parties, but then they punt the standards down to a standard setting body. And we sit in what will likely be the standard setting body at Trustly, right? The group is called Financial Data Exchange, or FDX. And you have to pick a lane when you're inside FDX because it's supposed to be a balanced standard setting body that considers everything, right? So whether you're a merchant using data or you're a bank or a fintech providing the data, right? You kind of have to pick a lane of where you sit. And I think what's interesting, right, is by having these lanes and then also kind of ignoring or shunting data access companies off. So there's kind of two worlds, either data provider or third party. I think we're going to have some weird outcomes over the next 10 years. And then the other thing is that if you're sitting at one of these companies and you're like, I have to do compliance with XYZ, yes, if you're going to be a data provider, or if you're a third party, you're using data, I think you need to be careful about crossing into the data provider lane. As Jeremy, I imagine you'll cover this in a few minutes. Those compliance dates are coming faster than folks may expect. So with that, I'll step back. I'll turn it back over to you.
Yeah, thanks, Matt. grateful that you called out the standard setting bodies. That is another key definitional term, and I think what we'll see is this idea of standard setting bodies not only kind of propagates through the rule, but also was a key part of the challenge that Natalie will cover as well. Covered data is account data that relates to a covered financial product or service. So again, these Reg E accounts and these Reg Z accounts, and includes things like transaction information, account balance information, payment initiation data, which you'll hear us kind of talk more about over the course of our hour together, and also other perhaps account-related information that isn't as conventionally thought of as covered data. So things like terms and conditions, upcoming bill payment information, and basic account verification information. So the scope of covered data is significant and broad. It also includes information that would include account data account and routing numbers, which could be used to effectuate payments. There is some flexibility in the final rule about how the data provider needs to provide that account information. It can be done in a manner that's tokenized, which was something that was raised in the course of the rulemaking proceeding. But there's a lot to unpack in the context of covered data. I'll pause.
Yeah, I think, Jeremy, I would hop in real quick just for a fun nugget on tokenized account numbers. We obviously have lots of feelings and things to say at Trustly about that, but one of the interesting quirks of the way the Bureau finalized the rule is that banks get to choose if they offer a tokenized account number as that payments number in lieu of the number that would be on your checkbook. By doing so, the current technology used to tokenize your checkbook number today and then offer that in an open banking context is not usable with FedNow. And so it was very fascinating to see the CFPB, which is very focused on competition and other things like that, allow an avenue for banks to choose to lock transaction volume to ACH and RTP. And that is something the Bureau is aware of because we've had lots of conversations with them, as is the Fed. But we found that was an interesting quirk coming out of the rule around the payment initiation data. Just wanted to call that out for folks because I think it's a fun nugget about where things landed.
Also, just mention what covered data is not, right? So I think that, you know, as in the context of data providers, it's as interesting what a data provider is, or who a data provider is and who is not. Similarly, in the context of covered data is not any kind of confidential commercial information. So underwriting algorithms, as an example, in the Reg Z context, it is not any information that's collected solely for the purpose of preventing fraud or money laundering. And it's not any other kind of information that would be required to be kept confidential by other provisions of law. So think suspicious activity related information or the like. So as interesting, I think, what is covered data as is what is not. The last definition that I'll just flag here, as we've already touched a bit on standard setting bodies, is the definition of third party. And a third party, the rule defines third parties who can access consumer data. And this is both third parties and data aggregators. So a third party includes any person that's in receipt of covered data that is not the data provider or the consumer. An authorized third party, which is a subset of third parties, is a third party that can seek to access covered data on behalf of a consumer and that meets certain specific authorization, the specific authorization procedure that's set forth in the final rule. And then data aggregators are still in yet another class that we've alluded to a couple of times here, and that is an entity that's retained by and provides services to authorized third parties to enable access to covered data. Okay. So now that we know who is who, I wanted to spend some time talking about the key requirements or obligations under the final rule for each of these class of stakeholders. So first, we'll start, I think, with the data providers, because the rule kind of builds off of the data providers. And essentially, the data providers have, I think, three general obligations under the rule. The first is that the data providers need to stand up a consumer and developer interface. And these are separate interfaces. Think API interfaces, right? Generally, just I think that's a helpful kind of mental construct. The interface needs to be capable of receiving and responding to data requests from authorized third parties or their aggregators. The interfaces need to be so in addition to kind of the developer interface where an ATP would come and call for covered data, the data providers will also need to stand up a consumer interface where a consumer, him or herself, can request covered data. Maybe I'll stop there and see if others want to talk at all about the interfaces that data providers are obligated to stand up.
I think one thing to call out, right, is this is going to tie back to the industry standard setting body. So ultimately, how do you know that you built a compliant API portal? What the CFPB did multiple times throughout the rule, and Director Chopra signaled he was going to do this, right? He said, I want a high principles level rule that's technology agnostic, that will survive form factor changes and other things like that. And that's not a bad way to go, but it punts so much down then to the standard setting body, where there's this question around, okay, is my API compliant? And I think one of the dirty kind of secrets out there is that even the banks that have APIs today are not fully up to compliance with the latest FDX specs. So FDX being the financial data exchange, right? That sets these standards in this cross-industry forum. That doesn't necessarily matter because, like at Trustly, for example, we connect to all those APIs and they get the job done, right? We're able to access the information. But as you go forward to be compliant, everyone's going to have to come up to the latest FDX spec, which at some point will encompass all of these new needs. I think one other interesting thing for folks who are thinking about what does a portal or API look like, to take you a level deeper, what it really means is you establish an initial connection with the bank where they can recognize your traffic coming in. So at Trustly, we go through diligence, contracting. In one case, we've been through contracting and diligence with a large money center bank for the last 2.5 years. And we're almost at signature on the contract. They're still doing approvals and whatever else. But we're not a scary company, right? We're profitable. We have SOC 1, SOC 2. We're connected to every other major bank. But for whatever reason, this bank's processes are just super laden. Once we get that connection, right, over with all of our other API connections, there's actually multiple API endpoints. And so as a company, you're only going to access and hit the API endpoint that you need to access the data you need to do that job for the third party, if you're acting as a data access company. Or most often where Trustly is, we have payment jobs we're doing. And so we have a certain set of API endpoints we're hitting around identification, payment number, and maybe transaction history. And so as you're peeking under the hood, it's not just one omnibus API or one endpoint if you're used to API technology. It's actually multiple API endpoints that get unlocked once you're onboarded to the bank and they identify and establish a regular traffic pattern with you.
I'll just underscore, everything you're saying, Matt, is obviously quite complex. And for a bank, especially of our size, we haven't really had to be, up to speed with everything that you're talking about, right? And that is going to be one of our major challenges is strategically, how do we think about 1033, right? Do you do enough to be compliant? Do you do enough where you're trying to gain market share or retain deposits? Or are you trying to be a market leader, right? Strategically, you have to think about where you want to be and how much you need to invest in all this stuff. And further to that point, are you building it or are you buying it? And if you're going to build it, where are you going to find the right people? How are you going to ensure you're meeting all the standards you just talked about? And those standards might be shifting over time. So it's not like a one-time buy sort of thing. It's more of an ongoing buy. So there's a certain expense, for that, of course. And if you're going to build it yourself, that's expensive resourcing for smaller banks to have to think about. And although the deadlines appear to be pretty kind to banks under starting at 850, right, being 2030. Yep. At the same time, I think as consumers get used to this and the prevalence of AI and AI bots that might be able to say, hey, go find me the cheapest checking account, or go find me the best credit card for my needs. Banks are going to want to be able to respond to those AI bots and be able to communicate with customers and gain market share. And the smaller community banks that are like not quite at 850 yet are going to potentially lose a lot of customers. So even though 2030 might be the deadline for the 850 to 1.5, I have a feeling that if a bank really wants to compete and remain competitive and retain customers and deposits, they're going to have to comply much earlier than this, even before it's required by the regulation.
Yeah.
Yeah, and Derek, I think you raised an interesting point. Jeremy, I'm going to steal ahead to some of our questions that you previewed with us. And so, one of them was, does this rule end screen scraping, or does it do enough? And I think Derek's poking at where the answer is no, or at least not immediately, right? Especially for those smaller banks who may never have to offer an API portal. I think if you happen to be one of those smaller banks and you're listening to this, the other thing to think about is there's a middle ground where there's a couple of key companies. I'll call out Plaid, right? A great company. I have a lot of friends who work at Plaid. They offer a decent product. They connect to Venmo. They connect to YNAB, right? Two popular tools that people want to connect their bank account to. So if you cut an access pathway with Plaid, they have products they can offer you, or a lot of times a company, whether it's Plaid, it's Trustly, Finicity, et cetera, we can talk to you and we can whitelist our traffic. Or you can whitelist our traffic, and then our technology can come in and access your data, and it's safe, right? You don't have to focus your limited infosec resources on us, on the whitelisted known traffic, right? It's coming from us, what we're doing with it. That's another middle ground where you can give your consumers access to these services without doing that. Trustly, for example, right, we run a merchant network that enables pay by bank, across hundreds of enterprise level merchants. And so if that's something you want access to, you can talk to our team and we could set something up, and you do not need to have an API, so your consumers can easily use Trustly. And again, same thing for those other ones. If you target those applications, that's a strategy potentially for smaller banks to use if you don't have to build an API and you don't have the resources to build one.
So agreed, but those all come with costs, right?
They do.
And
absolutely.
And that can be a challenge, for the smaller banks. Even at 850, 850 to 1.5.
Yeah. So maybe just a couple other points here, and then we'll proceed because I think they will be relevant as we go on. Banks are obligated data providers are obligated to enable access, as we alluded to. The rule prohibits charging fees for that access, which Natalie will call on here in a minute. And also I would just flag that there are specific standards against which the data provider can deny access. And the rule goes into detail talking about when it is appropriate or warranted for a data provider to deny access to covered data. The data providers need to have written policy procedures and reporting. There are SLAs that are expected of data providers in terms of responding to requests, and there is record retention obligations under the final rule. So that's one side of the market here, right? The other side of the market is third parties, and third parties have obligations under the final rule as well. So a third party is that's authorized by a consumer to access covered data will have to make certain authorization disclosures to the consumer. They will have to inform the consumer the name of the third party and the name of any data aggregator, as we'll get to, that the third party is using to access the data. They'll need to give a description of the product or service that the consumer has requested for purposes of accessing the data, and a statement as to why and how the third party will collect, use, and retain the data that the third party accesses through the interfaces. They're also limited on the extent to which they can use and keep data. The duration that the collection can continue under the final rule is 1 year, and the third party needs to give the consumer a mechanism by which to revoke authorization to that third party for collecting data. So there's a lot that will need to be covered in the authorization disclosure, and a lot of limitation on significant limitation on how that third party can use the data. And we'll talk a little bit more about use limitations here in just a minute, but I'll pause there.
Yeah, Jeremy, I would hop in that this can sound scary for companies. What I would say is that the rule just enshrines the status quo of what's happening in the industry today. So if you take a look at it, if you're accessing data through a third party, it could be a Trustly or a Plaid or MX. We have disclosures that meet these needs today. They need to be tailored a little bit. And again, one of the things we're waiting on to tailor them is FDX potentially being approved as standard setting body, and then groups within FDX aligning on what the standard looks like for these things. But we all have the base technology today, which really you're just going into update copy. And so you can lean on your third-party service provider. Now, if you've built your own connections yourself, and there are a few companies that have, you are going to have to take this on your own. The other thing that I would call it is use limitations. I don't think a lot of companies have thought about their data positioning. And the other thing is the Bureau hasn't necessarily done the industry any favors here by drawing any clear, bright lines you can look to point to say compliant or not. One of the things to think about is, when does your open banking data stop being open banking data because it's transformed into other data? And I think, one of the things we think about at Trustly is, because we're a payments company, eventually that data has to go into a Notcha file. And under the Bureau's rules, right, you need to be deleting and removing data in a lot of contexts, especially if it's after that 12-month data sharing period, if the consumer doesn't reauthorize. But there's almost a wall that has to be drawn, because when it goes into the Notcha file and gets submitted, right, to the ACH system for processing, or for RTP or FedNow or for something else like that, that data becomes other data, right? It becomes something else. And so I think companies today that haven't thought much about how open banking data gets distributed into their business. And there's a lot of billers that are using it. There's a lot of fintech companies that are using it. There's a lot of banks that are using open banking data. At a certain point, it'll stop being open banking data. And those are some of the questions, call MoFo. I recognize there's some other great law firms on the call today as well. Call your trusted outside counsel and work through some of these data questions, because that's going to be really important for you if you're using open banking data.
Matt, you raised the point about when it no longer becomes open banking data, and the Bureau has this term that they've introduced, newly generated data. I don't know if you have a view on whether newly generated data is a bright line, and what you think that standard might be. If it's just imported into a Notcha file, for example, does that meet an expectation for newly generated data, or is there some magic that needs to happen?
And I would say here, because the Bureau declined to issue an appropriate level of detail, and we asked them for it, we pleaded for it in our comment letter and in meetings with them. We said, hey, we need more detail to sort this out, because you're not just people aren't just building products from scratch. This is an existing industry and market that you're overlaying a regulatory framework on. I think, especially when it comes to things like payments, and that's just one example, you're going to have a lot of conflicting laws. Like at Trustly, for parts of our business, right, we're a registered money services business, and we have state money transmission licenses. That means we have an independent obligation to retain data under the Bank Secrecy Act, right, for 5 years from the end of that customer life cycle, right, with folks. And we have to do SARs. We have to do other things like that. We have to retain the data supporting it in case law enforcement turns around. If the Bureau comes in and says, sorry, all that's open banking data and you have to delete all of it, and then law enforcement turns around and says, hey, we're actually interested in this, right? This is an important, critical national security issue. or just a local law enforcement issue that we want more information on, or we're going to root out a fraud ring or, you know, something, organized crime, something else like that. We can't turn around and say, sorry, the Bureau made us delete it, right? We have to hold on to that. And that's where I think, you know, the Bureau has abdicated its responsibility and kind of now let the industry fill in, right, what it means, what this newly generated data means, because it has to mean the NACHA file, right? My NACHA file is covered under the Bank Secrecy Act. And so that I can't delete that. I can't delete key pieces of it and have Swiss cheese to appease the Bureau for what Rohit Chopra wanted to be a privacy law, right? When it's really supposed to be, the way the statute was written, is supposed to be an enablement regulation, right? Enabling consumers to share their data so that way people could do jobs with it in a very transparent manner. So I think, you know, those are some of the things the industry will definitely need to sort through, but I think where we'll ultimately land is that anytime that data goes into a new job, right, a NACHA file or a KYC file or something else like that, it has to be newly generated data, because that's the only logical conclusion to then comply with the other laws that overlay over those of us in the industry that are working with this data.
Something you just said also, right, in terms of the accuracy of that data and the recency, the newly generated data, you know, that is obviously a concern for banks, because we don't want to act on incorrect or stale data and open an account that we wouldn't otherwise open, or process a transaction that we wouldn't otherwise process, right? So I think it raises a number of questions about BSA and AML risk and fraud risk as well.
Yeah. So we wanted to cover a few of the key dates as it relates to the final rule. The rule was published in the Federal Register in November, and the effective date of the rule was 60 days after publication. So it will be January 17th of next year. The rule has a phased compliance required compliance date, depending on asset size or annual revenue asset size for depository institutions and annual revenue for non-depository institutions that are subject to the rule. As Derek previewed, that phased implementation schedule starts April 1st of 2026 and rolls through April 1st of 2030, at which point the smallest institutions that are subject to the rule, remember that institutions under 850 million are excluded, but by April 1st, 2030, depository institutions that have 850 million in total assets will be required to comply with the rule.
I think just one quick add there, Jeremy.
Sure.
Something that we had talked about in the lead up to this panel is that for a bank that crosses that threshold at any time and then potentially drops below it, is considered to be over the threshold. So if there's any sort of wave happening, the second you cross it, you're in.
Yeah, that's right. There's a standard in the rule as to how and when you cross the threshold to become subject to the rule. But to Derek's point, once you do cross that threshold, it's a one-way filter. There is an interest. So this is all required compliance dates for data providers, and the rule, as we alluded to or previewed, triggers off of covered data. And so when a data provider is subject to the rule, then they provide covered data, and authorized third parties and data aggregators on behalf of authorized third parties can access with authorization that covered data and will be subject to the requirements that we just went through. What the rule does not specify, and the language in the supplementary information that the Bureau published with the final rule is a bit ambiguous on, is when the authorized third parties become subject to the rule. And so, you know, we've had some conversations among the panelists, and certainly I think in industry, there's some discussion on when, in fact, the authorized third party becomes subject to the compliance obligations of the rule. So, Matt, I don't know if you want to kind of kick off the discussion here, and I can layer in.
Yeah, I think, there's probably two things for folks to think about if you're using open banking data. One, ideally, if you're working through a third-party provider, again, somebody like a Trustly or a Plaid or MX, we're going to be doing a fairly heavy lift to make sure that we can help you comply with these things, right? Because we have to do it ourselves. And so you can almost get a little bit of a free ride, or maybe most of a free ride, off of working with a third party in this space. You still could do it by yourself, right? Because banks now have to give this data out for free. So you want to connect to the largest banks in there and you can do it. There's a cost, right? You have to maintain an internal team. There's a business relationship you have to have with those banks. So things like that, where the scale you'll get from working with a provider probably makes sense. As you're thinking about that, your provider will have turnkey compliance tooling, for as soon as the first bank is ready. And I think, Jeremy, one of the things we were talking about before the webinar was, there's a chance, or if you're a third party company, there is a risk to you as you think about when you have to be compliant, that a large bank could come out and say, we're ready. We're going to be compliant in a quarter, right? In 3 months, in 6 months, et cetera, and be compliant before that April 1st, 2026 first compliance deadline. And that's because that's a deadline, right? Not necessarily the start date of compliance. Now, the other thing and why that's important is because the way the rule was written is your obligations under the rule as a third party. So your new disclosure obligations, your data use limitations, which are very important because the rule limits secondary use of data. Your historical data set will not be subject to that. If a bank waits until the last minute to be compliant, your data set you collect before the bank becomes compliant is not subject to the secondary data use limitations. But once that bank becomes compliant, and the banks are going to come online in planks and tranches. And then as we talked about earlier, your access company needs to connect to that bank, right? And there's going to be a queue for the banks that don't currently have APIs available, right, to connect us as access companies. So if they take a while to get around to the access company you're working with, you actually could have access to data and not have to comply with the rule past the April 1st, whether it's 2026, 2027, or 2028 deadline. And I think that's a flaw the Bureau put in there. Ultimately, the market will transition, but it's a flaw the Bureau put in there because you're going to have this like weird battleship-like compliance date strategy. Now, as a third-party provider, right, it's better for you to just come out, be ready on a certain date, especially with those data use limitations, and making sure you have a split on pre-rule data and post-rule data, right? And when that's going to be compliant. At least that's my view. That's our view at Trustly of it. But as you're thinking about when do you have to be compliant specifically, right? You can really get very tactical about it if there's certain data sets you need that are important, or certain things you need to do with that data that you can do today that you may be hampered or limited with under the rule in the future. Jeremy, anything else you want to talk about on that?
So we've been talking about certain dates, one being the effective date of January 17th, the other being the required compliance date. What is missing from that timeline is when, in fact, industry will have the standard against which they need to comply with. And so there are two, as we previewed earlier, there are two applications to be standard setting bodies that have been filed. The Bureau hasn't yet granted an application or designated a standard setting body. And then once the Bureau does, then that standard setting body will have to go through their process, and it's required that they have a process, a transparent process, will have to go through their process to establish a standard. So it isn't like a data provider could be compliant with these standards by January 18th, 2025, for example, because they will need to solve for a particular problem. Not problem, they will need to solve for a particular standard. And then at that point, they could become compliant with the standards, at which point the authorized third parties would need to be able to comply, because at that point they would be calling on covered data. So there are a number of steps that need to fall into place here. It is not as straightforward as you need to be compliant on January 17th. It's also not as straightforward as you can wait until April 1st of your designated year to become compliant. It's a little bit more of a give and take. Okay, so now we can call on our litigation expert, Natalie. Natalie, I'll just turn the floor over to you to talk a bit about the bank challenge to the final rule.
Yeah, so October 23rd, 2024, as it says on the slide, the same day the final rule was released, a national bank and 2 bank trades challenged the final rule. And so it was a very fast challenge. It's definitely a statement that is made that says, you know, we're ready and we're here to fight against this rule. So the claims are there's multiple claims. They actually filed an amended complaint a few weeks later and added some additional claims from that initial complaint. But the basic allegations are that the CFPB exceeded its statutory authority in several provisions of the rule that we'll talk about. One of the key ones that kind of the focus of the litigation in a lot of ways is that the argument is that 1033 required the CFPB should have had rules that allowed consumers to access their own data. And so one of the questions is, what is a consumer? As we were just discussing, there's a whole section of this rule that has to do with authorized third parties, with data aggregators, with other entities that are not traditionally who you would think of when you think of who is the consumer. And this litigation argues that the Bureau went beyond the scope of 1033 by creating this whole mechanism for access by authorized third parties, that although those third parties have to get authorization from a consumer in order to get access to the data, they are not themselves the consumer. And the part of the allegation is that that's just outside of the scope of their statutory authority, whether or not it's a good idea or a bad idea, that the complaint alleges that it's outside the scope of the Bureau's authority. But then additionally argues that it's arbitrary and capricious, which is a hard standard. It's a standard under the Administrative Procedures Act. But you say that a regulatory body really, even if they acted within their statutory authority, they did something that just is going to be harmful, it doesn't make sense. They didn't consider all of the factors that they were supposed to consider. They didn't take into account the comments they received during the comment period. And here, the complaint discusses, makes allegations that allowing this kind of access to these third parties is significantly riskier for the data than allowing an individual consumer to have access to their own data. That this is a very different concept that the Bureau is tackling here, and that allowing all of these third parties is specifically because there are limitations on when the data providers can say no to an authorized third party. And part of this complaint says, no, banks should be able, because this complaint was brought by banks and banking trades, banks have their own procedures, and they have like very strong obligations to protect cardholder data, to protect all of this sensitive information. They should be able to do that without limitations that the Bureau has put into this rule on when they can deny access to an authorized third party. So that it's outside of statutory authority. It's also arbitrary and capricious. There's a lot of focus on the complaint as well about the standard setting bodies. The complaint argues that this Bureau went too far here because they're delegating too much authority to the standard setting body, and that the standard setting body cannot take the place of a regulator and should not be able to do the types of things that the Bureau is asking the standard setting body to do. Part of the discussion we were just having about when can banks come into compliance, when will the standard setting bodies have the things set in place that banks are building toward. The complaint actually argues that it's arbitrary and capricious to have any compliance deadline right now because there is not yet a designated standard setting body. And so how can you set a timeline for compliance when you don't even know what those standards are or how long it's going to take to develop those standards? So there is an argument that there shouldn't, until, if it's permissible as a constitutional matter or a statutory matter to create these standard setting bodies, and to allow them to create these standards, then the Bureau must, the complaint argues, have that process in place before they can set deadlines for compliance, so that there should not be compliance deadlines at this juncture. There's also discussion about the prohibition of charging fees to third parties for access to data. There, one is that, again, it's outside the statutory authority. If you read the actual language of 1033, there's nothing in there that talks about limiting the fees or that it has to be without cost. And so they say that's just something the Bureau added. Congress didn't intend that. Congress didn't put it in the statute, so they shouldn't be permitted to do it. They also argue that it's arbitrary and capricious to just ban any kinds of fees to third parties for access to data. they also, there's a focus on the fact that the Bureau did not, the complaint alleges did not take enough responsibility for what might happen if there are breaches, and this data is not properly held, that there's too much responsibility placed on the data providers to oversee the process, that they should not have to, that the liability shouldn't fall to the original data provider when they are being forced, in their view, to provide this data. They are not being permitted to have the same safeguards they normally would when they have this extremely sensitive cardholder data. In particular, payment initiation data. They argue that it's beyond the scope of 1033 to allow payment initiation data. There are certain specific types of data that are referenced in 1033, and the complaint alleges that payment initiation data is not included in that list, and that actually it's arbitrary and capricious for the CFPB to include it because it is much riskier, because it can provide access to the accounts, and how to initiate access to the accounts is much more sensitive than the types of data that 1033, the statute, was talking about consumers having access to. And so this complaint is one of many complaints against the Bureau and rules that they've done, and other government agencies. Folks on the line are probably aware that the Supreme Court overturned the Chevron doctrine, which had provided deference to regulatory agencies when they were making when they were interpreting ambiguous statutory language. So there is a lot of appetite for challenge to regulatory agencies now, especially when there are arguments that they're gone beyond the language in the statute, or they have acted in a way that that is arbitrary and capricious. And so we expect to see a continued onslaught of challenges to agency action in light of the Supreme Court's view that agencies have really overstepped sometimes, and that courts do not need to give them the same deference that they have previously given them. And so that is kind of the state of the litigation right now. We will be continuing to follow this litigation and see if any other litigation is filed related to this rule.
Thanks, Natalie. And I recognize that there are a lot of non-lawyers on the call as well, but just to kind of pick your brain a bit further, it seems in some respects like the Bureau anticipated a potential challenge, and I wondered if you could talk a little bit about some of the creative rule writing that the Bureau engaged in, particularly as it relates to severability in the final rule, just briefly, so that we don't put the non-lawyers to sleep, but just wondered if you had any thoughts there.
Yeah, so severability is the concept that if there's a challenge to a rule, if one piece of the rule fails, the rest of the rule can continue on without it. And so a lot of times agencies, when they create rules, they want to put in severability language that says, so one example there would be, if you decide, court, that okay, it was beyond our authority to say you can't charge any fees to third parties for access to this data. If you agree with that, that doesn't mean the entire rule gets vacated or the entire rule goes away, because you can just narrowly fix that problem where you can say, okay, well, we're going to strike the part where you can't charge fees, but we're going to leave everything else in place. And so agencies want that. They want to be able to have most of their rules survive, even if part of their rule goes a little bit too far. And so the CFPB did include kind of standard severability language in their rule, but then they had a second paragraph that was specific to subpart D, which we've been talking about with the authorized third parties. And they say, if any provision of subpart D in particular is stayed or determined to be invalid, then all references to authorized third parties should be read out of the rule. So essentially they're saying and this is unusual to really kind of focus on one specific part of the rule in the severability language itself, and to say, okay, well, we think mostly it's severable, but in this one particular instance, if you decide that you're going to take away part of this, then we want you to read the rest of the rule without reference to these authorized third parties. I think recognizing that they would be creating quite a quagmire if they took away some of the prohibitions on what authorized third parties could do with the data. If the court said, that's too far, we think that's outside of your statutory authority, but then you still had data providers obligated to give data to these third parties, but you didn't have the authorization procedures, the reauthorization procedures, and all of these safeguards that the Bureau tried to build in for protection of that data. But that was it was interesting. I mean, I don't know if someone from the Bureau would agree with my read on this, but it kind of seemed to me like you kind of know that subpart D is a little, there's nothing in 1033 that talks about authorized third parties or secondary use of data. I mean, and how they can use it. So that to me signaled that they were thinking that a challenge might come. And like I said, they get challenged all the time. So it wouldn't be, you don't need a crystal ball to think that the CFPB is going to be sued when they do a controversial rule. But that was pretty interesting.
Thanks, Natalie. We had a whole list of questions that we wanted to cover, and I'll maybe open it to folks to maybe weigh in on one or more. I think the last point that I would make, though, obviously in this time where we're preparing for a change in administration at the start of next year, this rule was finalized and will take effect at a point where there is a new administration coming in. This rule is not, this rule has support on both sides of the aisle. And so, it is not, it's not clear that this rule would be a priority from a Congressional Review Act perspective. But that remains a tool that unified government will have going into the next Congress. And so, a part of the context against which this rule was finalized. But let me open up to others in the last few minutes here to see if there's anything else that they would like to, any other thoughts they would like to share before we conclude.
Derek, anything from your end?
Yeah, I guess a couple closing points, right? There's going to be such an intense increase of focus on APIs. And I think there's going to be a need to ensure that API security and API performance continues to operate at a level that we have not really seen before. So that's something certainly that people should be thinking about. And also in terms of IT architecture changes that might need to occur, and ensuring that your bank is able to produce these types of records to fit into the APIs. For me personally, I find that the terms and conditions is a particularly challenging aspect, right? And then finally, the considerations that banks will have to make in terms of how they evaluate third parties that are going to operate in the 1033 kind of ecosystem, and how you're going to be able to maintain oversight that those third parties are actually operating the way that they should be. So those are, I would say, would be my closing thoughts on the matter. So there's certainly a lot more to play out, right? And I tend to agree with some of the challenges that the banks have already made in terms of the standard setting body. It's really hard to hold somebody accountable to standards that might be implemented, a couple months before. So I imagine that there will be extensions or some sort of give a little bit on some of these dates, but there's a lot to learn. And I think at the end of the day, the banking system will be better if people are able to own their own data and transfer it the way they want. I think that's the direction we should all be trying to get to, but getting there is obviously going to have some complex challenges. So I'm really glad that we highlighted some of those today.
Thanks, Derek. Matt, we'll hold your closing thoughts for next time around, or over drinks at some point, and we'll turn it back to Phil and the AFC team. Well, if they're not going to thank everyone for joining, I will thank everyone for joining on their behalf. Thank you to the panelists for the conversation. There's a lot to digest, lot to unpack here, and thank you for your contributions.